So I know this topic might feel like I'm a dog with a bone talking about this topic and pretty much every I have other topics I do want to get to, but this is such important stuff, and every day there's a new development. So I wanted to kind of scratch this itch a little bit more. So let's get to it. I hate to say it, but higher inflation is unavoidable. All right, let's talk about it.
Romance for lovers only.
Okay, so is higher inflation in the cards? Does it have to happen? Well, in my opinion, yes, it does. So let's get into that and talk about what you should be doing right now. Okay, so let's start by taking a look at an article out of CNBC, and then we'll talk about it. Okay, after First Republic's rescue, economists predict further pain with a new era of higher inflation. Central banks around the world have been aggressively raising interest rates for over a year in a bid to curb sky-high inflation. But economists warned in recent days that price pressures looked likely to remain higher for longer. Almost 80% of chief economists surveyed by the WEF, but there it is, said central banks face a trade-off between managing inflation and maintaining financial sector stability. Now let's talk about that for a second. Okay, so the cause of the recent spate of bank failures is largely due to the historical rise of interest rates. Interest rates have gone up at the fastest pace since 1980. And all these banks, they have the same stuff on their books. All of their debt-related securities have gone down in value as interest rates have gone up, because that is the way bonds work, right? Bonds have an inverse relationship with interest rates. As interest rates go up, the value of bonds go down. So the balance sheet of these banks have been just decimated. And the more interest rates go up, the worse it's going to get. Now, raising rates is the Federal Reserve's, all central banks, it is their chief tool in fighting inflation. And so as inflation goes up, they've been raising rates. And they've had to raise rates so dramatically because they kept interest rates low for so long. So these central banks have a choice. Do they keep raising rates in an attempt to fight inflation and at the same time hurt the economy, make your lives miserable? Or do they chicken out? Do they succumb to the pressure by Wall Street and pivot and start sending interest rates down again? Well, if that happens, then we're going to see hyperinflation. On the one hand, they have to make your life so miserable that you stop spending money, or they pivot, send interest rates lower, and then you see hyperinflation, which is also going to make your life miserable. Either way, every aspect of our lives are going to become more expensive. In the West, we are debt-based societies, and this is the monster that we have created. Central banks around the world have been aggressively raising interest rates for over a year in a bid to curb sky-high inflation. But economists warned in recent days that price pressures look likely to remain higher for longer. The WEF Chief Economist Outlook report published Monday highlighted that inflation remains a primary concern. Almost 80% of chief economists surveyed said central banks face a trade-off between managing inflation and maintaining financial sector stability. Now, I'm not going to play this video here. Let's just read this one line here. We're entering a structurally more inflationary world, and that will mean more failures. Okay, so remember, interest rates have been the boogeyman in the financial industry lately, and that's why banks have been failing. Okay, well, if the central banks sincerely want to fight inflation, they have to keep raising rates, quite a bit more, actually. And by doing that, they're going to make every aspect of all of our lives more expensive. Inflation will be coming. Okay? With the rise of rates, everything is going to become more expensive. Now, the alternative of that is to pivot and start lowering rates. But by doing that, they're not fighting inflation anymore. So that would have the probability of sending us to hyperinflation, which would also make our lives more expensive. So these central banks are in a bind. Either way, our lives are going to be made more miserable. So I don't see how you can avoid it. Now, listen, back in 2008, the big culprit for that financial disaster were mortgage-backed securities. And everyone got a very quick lesson in mortgage-backed securities. Now let me tell you about the bogeyman in this next financial crisis. Instead of mortgage-backed securities, it's going to be commercial mortgage-backed securities. A lot of buildings are lying empty. Now, you probably have not heard of commercial mortgage-backed securities, CMBSs, before. But my guess is before too long, you're going to see report after report about CMBSs, and you heard it here first. So listen, if the central banks continue to raise rates to fight inflation, our lives are going to become more expensive. If they lower rates and create hyperinflation, then everything's going to become more expensive. Either way, brace yourselves. Start taking steps. Reduce your exposure to your bank, put some of that money into gold and silver, and establish streams of passive recurring income. So in the comment section below, please let me know what you've been doing lately. Have you been reducing your debt? Have you been getting your money out of the bank? Have you been buying gold and silver? And I would love to see your comments. But in the spirit of respecting your time, we'll leave it there. All right. How'd you like the opening there, Rob?
Yeah. Ed, you're the Jedi Grand Master at explaining those really complicated subjects, and you do it in a way that just cuts through all of the spin. So I want to say thank you for doing that and putting that together. It's really when you explain it like that in really simple terms, it kind of makes me even more worried for the economy as it is. What are we at now? 5.25%?
The federal funds rate, yeah. Mm-hmm.
So why don't you tell people, when you were a lot younger, back in the 1980s, when you arrived on Wall Street in 1987 before it tanked, what were the interest rates then?
And I know you know the answer to this. That's why you're bringing it up. You wanted me to admit my first mortgage on my first house, which I bought in 1987, 2 weeks
Same
after
year the stock market crashed.
Yeah, 2 weeks. Yeah. And I bought that house like 2 weeks after I became a stockbroker. Talking about getting ahead of the curtain. I was really stretching myself. But I was married to a girl who had to buy the house. She was in a hurry to buy a house. The mortgage on our first house was 19.5%.
Holy cow, man! It's like buying a house with a credit card.
yeah. People look prior to this this last decade, mortgage rates had not been below 5% since World War II. Right? So people now are spoiled. We do have a generation of people now who don't know what high interest rates are. Right? They've been spoiled. We had 7 years there at 0% interest rate. They think that's normal. That is not normal. Now, the Federal Reserve, all the central banks, they're in a tight spot right now. Now, in the West, we kind of painted ourselves. We created this monster. It was eminently unavoidable. The issues we're having right now were predictable. You know, I mean, I saw it coming. I've been talking about it for 2 years. You've seen it coming. If Ed Anderson in Wayzata, Minnesota can see it coming, some guy in a $5,000 suit in Wall Street should have been able to see it coming. You know, so this is very predictable and it was unavoidable. Now, we're assuming that the Federal Reserve wants to do the right thing. Now, the Federal Reserve's mandate is supposed to be to control inflation. That's their primary job, is to control inflation. And the target is supposed to be around 2%. They claim it's 2%. That's pretty much their job. They have money supply stuff and all the rest of it. But the primary job is to control inflation. Well, if they are legitimately going to try to fight inflation, you have to raise the federal funds rate above the rate of inflation. Right? Which means we have about another doubling of interest rates to go, assuming inflation doesn't accelerate more.
Well, it's almost, when you think about it, it's almost a tripling, right? Because if you Google it right now, you'll see inflation is around 8%. And so if we're at 5.25 or 5.5%, say, you literally have to double. But in real life, let's be real for a second, inflation is not 8%. Inflation is more like 15 to 20%.
Correct.
So in order for it to actually get under control, it doesn't matter. That's what you keep saying. And I don't think people really understand that. And in order for this to actually get under control, interest rates need to be near 20%, where it was in 1987 when you bought your first house. But that's never, ever going to go there, because to your point in the video there, as soon as interest rates go up, that inverse relationship with the bond market, and the bond market's the biggest market in the world, if interest rates go up much more than it is, it's going to collapse all of the banks, even the big ones. All of them.
Bingo. You nailed it. And that is the issue, right? If we've seen some major banks go under already with the rate increases we have, what would happen if they raise rates more? We're going to see more massive bank failures.
And
It's
that's
going
just
to
their
happen.
exposure to the bond market, right? That's the reason why.
Exactly right. So that brings up the question whether they're sincerely interested in fighting inflation or whether they're perfectly happy to raise those rates because it is going to put those banks out of business. And in my opinion, I think that is part of their agenda. They do want to whittle down the number of banks. And I think they do want to get it down to the top 3 or 4 banks. So this idea of banks failing behind closed doors, when everyone's got their cell phones turned off, I'm sure they're cheering that these banks are failing because it's moving them toward. They'll never say that in public. Okay, so but just for just so people understand, look, whether this is by design or by incompetence, what does it mean to us? What does it mean to you? And the net result is, well, if they raise interest rates in their effort to fight inflation, everything becomes more expensive. Loans,